Okay, I think we might make a start, and we'll start with just a few introductions and a bit of housekeeping before we commence tonight's session. But everyone, thank you very much for attending Australian Catholic Super and Retirement Fund's investment review. We do these quarterly. There is certainly a fantastic update that is provided by our investments team that gives us some detail of what not only is going on in the investment markets, but also what is going on in the fund in terms of investments and the returns. Tonight's presentation, I'd just like to state that Michael Block is an apology for attending tonight. I would say that we've got a more than capable replacement for Michael. We've got John Fokos, who is an investment manager with the fund, and he's an investment manager of our private markets. He's been with Australian Catholic Super since 2015. In his role, he manages the fund's bonds, credit, property and infrastructure portfolio. John's a very hard worker, and you can certainly, John takes some claim and credit for some of the fantastic returns in our more conservative options that have a greater exposure to these types. So, and I think you should congratulate yourself when you're doing tonight's presentation. So thank you very much. John has spent 10 years working at a senior investment role with WorkCover, which is now previously iCare. He's certainly got a number of education backgrounds, but more importantly, he's got a combined bachelor's degree in science and education from the University of New South Wales. So there's no better person that has an understanding of our membership of the fund when you've got someone here who once was a teacher. So he's certainly gone through and provided the fund with some fantastic investment properties in portfolios. So we welcome you, John, and thank you for attending and presenting tonight.
Thank you, Paul.
So first of all, we start tonight's session with a welcome to country. I would like to acknowledge the traditional custodians of the land on which I work and live, and recognise their continuing connection to land, water and community. I pay respect to elders, past, present and emerging. Thank you. In terms of tonight's session, normally, if you've ever been to a financial services company's presentation, we always must start with a disclaimer. And this very much disclaimer I always say when we're doing a retirement planning presentation. My view is that if you can read all of that, you're not ready for retirement. I suppose I can say is that tonight's presentation, both John and I, we're only talking about factual information. This cannot be construed as financial planning advice, and we've not taken into your own personal circumstances, goals and needs. So we do recommend that you do seek financial advice if you're unsure of any action. I would highlight that the product disclosure statement is contained on the fund's website, together with the financial services guide. I recommend that you can view those on our website at www.catholicsuper.com.au. In tonight's session, we're certainly going to provide you with an update. Feel free, if you have any questions, down the bottom of your view, you have a Q&A or a chat facility. You can ask some questions at any given point in time. Providing that we're keeping on track and on subject, I might interrupt John as he's going through and ask John those questions. So if you don't mind, John, I might butt in every now and then.
Sure.
But otherwise, there's certainly a section at the end of the presentation whereby we'll go through and answer any of your questions that you may have. So we'd certainly encourage you to do that. So it's just a matter of typing down below and we'll have some assistance there. Certainly, during tonight's session, we'll be putting through a link to that in that chat facility, whereby you can seek some further information from the fund. And we will go through those options in a moment. The other item is that after attending tonight's session, you will be receiving a link or a survey where you can get some further information from the fund there as well. For the purposes of tonight, this session is actually recorded and will appear on YouTube. So if you do want to watch this again, you would just need to go to the Australian Catholic Super and Retirement Fund's YouTube channel. So thank you very much, John. I suppose in today's economic world, there's a few things to talk about. All things appear rosy, but let's look underneath the bonnet and see what's going on. So John, welcome tonight, and if you could present to us the investment update for the quarter.
Sure, thank you, Paul. It's my privilege, members of the fund, we're privileged to present to you tonight. As we said, Michael Block, our Chief Investment Officer, is an apology, but he's around and listening and may chime in. My name is John Fokos. I'm the Investment Manager of Private Markets, as Paul said. I've been with the fund for over 6 years. And I can tell you that there's no one person that drives these returns. It's a team effort, other than maybe Michael himself as the chief, driving our the team. So thank you, Paul, for those kind words. What I'd like to do tonight is provide you a market and economic outlook, a read on how we see financial markets, and how we've positioned the portfolio, how the funds performed across the various investment options on our menu, and then just a little bit of a spotlight on the investment menu itself, just to try and demystify a little bit super and what goes inside super for some members who might not be across it, and just explain that a little bit more, and then throw it over to you for some questions. So in terms of the market and economic updates, firstly, starting off, I hope everyone is safe and well tonight. We are in Australia broadly in lockdown and impacted by COVID-19, particularly the recent Delta strain. And of course, we begin there in terms of the impacts of the Delta strain or COVID on financial markets. And COVID infections have continued to rise around the world, both here, but more particularly abroad in the UK, the US, and the subcontinent, Southeast Asia, Europe, where infection rates are climbing quite rapidly. And yet there is a difference this time with Delta in the populations where vaccination rates are much higher than in Australia. We're lagging a little bit, but we are catching up very quickly just at this moment in terms of our vaccination rates. And the critical difference is that, the sickness or, morbidity and even, needing ICU care and so on is much lower compared to what it was through the early onset of COVID. And that's primarily to do with vaccination. So that vaccination is having a positive impact in terms of morbidity and death or mortality, sickness and death. And that is what the markets are looking through at the moment, combined with unprecedented synchronized central bank intervention around the world, both in terms of monetary policy, and that's in terms of how interest rates are being forced down by the central banks and making the cost of borrowing lower. But also this has been joined with fiscal stimulus by governments around the world to try and support the various economies through this difficult time. And so what happened is, you might think that with all of this negative impact coming from COVID, you might think that the markets should be coming off or not too flash or something along those lines. But actually, we've had an incredible 12 months, if you like, where the markets have really looked through, looking much more forward than perhaps most of us do, and considering that stimulus and considering how we'll come out of this, and these have been embedded through very strong returns. Inflation and growth came off quite sharply through COVID, particularly in the first half of last year. And what we've had now is a rebound in growth around the world and here. And along with that, inflation has come up a little bit of a spike here as well as abroad. And that's primarily because we're coming off a low base where inflation and GDP growth has come down quite materially, negative even. And so with that lower base, as we see the recovery pre this Delta strain, we've got a little bit of a spike in inflation. Most commentators would believe, or would state that would be transitory and not permanent. And there's a lot of debate about whether that will be permanent or not permanent. There's lots of debate around supply chain disruption and whether it be the inflation will be staying with us a bit longer or not. And there's no crystal balls here, at least not from me. So despite these high valuations that we're seeing through these strong market returns, we remain cautiously optimistic, but very, very, very cautious, and you'll see why as we talk to the valuation metrics that I'll show you soon. In terms of the market returns for the financial year, we start here with our ASX, Australian Stock Exchange 300 accumulation index, which means dividends being included. And for the financial year 2021, we have a 28.5% return, which we believe is the highest financial year return in over 30 years. So very strong returns, and again, very strange given the context. But as we say, the markets look forward. The NASDAQ, which is the tech-heavy index in America, up 44.2%, and the more broad Standard & Poor's 500 up 38.6%. The Nikkei, which is in Japan, the Japanese index, up 29.2%, and so on. You can see this right around the world, with Europe up 25%, China up 20%, the UK up 14%, and commodities. You might recall that futures for oil futures through COVID fell even below zero at one point, and today, we see them up 87% year on year, and now back up to $73.60 a barrel. Copper is also up to 55% for the year, and there's the demand for a lot of the things that Australia exports, iron ore, copper, and so on. And so commodities are on the rise, and that seems to be consistent with this notion that inflation is on the rise as well. But to the defensive parts of the markets, the cash and the bond markets, we all know that cash yields, you don't get much for your term deposit with a bank anymore. The RBA has targeted an overnight cash rate of about, I think it's 0.1%, very low. And this is the same around the world, with central banks doing the same sort of thing with their cash rates. In addition, central banks, as you might have heard, terms like quantitative easing. All that means is that the central banks are buying the bonds that are issued by their respective governments on the broader market, just to try and manage the yields down, not just at the cash rate, but even out to maybe 3 years, like we do in Australia. And the net result of all of this, of course, is that we've seen residential property prices, not just in Australia, but abroad, spiking quite sharply. It's the availability of credit at a low interest rate, which means the debt servicing costs for borrowing money to buy a residence, it makes housing more affordable in that regard. But of course, saving up now for that deposit is a little bit harder for the younger ones. In terms of valuations, where we think that equity valuations are a little bit, well, they're quite high historically against any measures on a historic basis. Just looking at these 4 charts here, we have something called the Shiller PE, which is just the measure of normalized earnings over a longer period of time. You can see that that's not quite caught up to the 2000 period where we had the tech bubble. You can see that on the bottom left, the Wilshire 5000 as a percentage of GDP is now at very, very high levels. That chart goes back to the early 70s. And that's a measure of what's the value of that stock market, or that index of stocks in the US as a percentage of their economic output. And as you can see, we've way surpassed the year 2000 tech bubble on that measure. On the top right, we have the Standard & Poor's 500, which is the broad stock index in America, against an emerging market index. And what this is saying is that there are pockets of value around here in the stock markets, but you need to go to the emerging markets to find these, where we believe that the emerging markets have been more prudent with their monetary policy, not borrowed as much, and their economies therefore also haven't been recovering as strongly as the developed markets. And so we think that there's good value in the emerging markets relative to the developed markets today. In terms of the stimulus I spoke of earlier, it is unprecedented. You can see this is a chart here of the federal, the US government's total public debt against their economic output, GDP ratio, public debt to GDP ratio. And this goes back to the early 1800s. And you can see these spikes historically through the US Civil War, World War I, and then World War II, where we got up to 125% debt to GDP. And we are not at war. Some say we're at war with COVID, but we have broken that peak of 125% debt to GDP against that time during World War II. So it is historically high. Now, there's been some fiscal stimulus along the way as well, where money is landing in the hands of the average person in the US, and as well as here with JobKeeper, JobSeeker. These are some indications of what some participants, I think this one would have been in the US, about where that stimulus might end up. And the concerning factor here is that some of that stimulus is ending up in the markets. So that could be one reason also why markets have been very strong over the last year. So in terms of your portfolio, how we manage the portfolio of assets.
Sorry, John, to interrupt there. We just have a question through, and thank you very much for sending that through. Could you just explain where are the emerging markets, and is Australian Catholic Super actually physically invested in them?
Yes, that's a great question. So the emerging markets might be not places like Western Europe, the UK, not Japan, not the US, not Australia. It could include India, it could include Mexico, it could include South America, for instance, Argentina, Brazil, some areas, some countries through Southeast Asia, maybe Vietnam, and so on. So there's pockets of around the world that we don't consider fully on par with the developed markets that I mentioned earlier, and it's these countries that have been a little bit more fiscally conservative in terms of their borrowings, and they just haven't come through with those roaring stock markets, and therefore represent a bit of value. Does that answer the question?
Yeah, I think so. And we've certainly got exposure towards those emerging markets.
We do. We allocate to specialist asset managers, investment managers that specialize either in developed markets or in emerging markets, where they have an edge, hopefully, particularly in emerging markets, which are not as well researched as the developed markets and the large markets like the US stock market and the big sort of set of companies, where the sort of due diligence and some specialist asset management houses are able to extract extra return than just the broad market return that those markets offer.
Lovely, thank you. John, would it be fair to say that are the emerging markets more vulnerable towards COVID situation?
Yes, it is. It's a fair comment. In fact, one of the big pushes at the moment in the developed markets is to share our, I guess, our vaccine stocks to get people vaccinated in the emerging markets as well. Because as we open up borders at some point, then we're going to want those populations to have reached a critical mass of their populations being vaccinated if they're going to be coming and visiting any other country. So It's basically, it's in the world, and you can think of us effectively as one world. Just like, if you think about each of our cities at the moment, Sydney's got a number of LGAs in lockdown. There's some debate about whether you open up some LGAs and lock down others and so on. The thing is that it's just, we're just one intermingled city, as are all the other cities. And, we started off saying we're all in this together. I actually think that that's true. We're all in this together, but that applies also in a global sense.
Okay, thanks, John.
So as the screen says, our primary goal has always been to grow your retirement savings as safely as possible so you can retire with dignity. The point about super is to accumulate, as you're working, assets that you can then draw down an income in your retirement to meet your living expenses through retirement. So we want to prudently invest in portfolios in a risk-controlled fashion to try and optimize the balance, but also think about the trade-off in terms of what risks we take to grow your balance. So it's a fine line, and that's what we try and do. So what are we doing in light of the current climate? So, as we say here, the high growth and moderate inflation favours a cyclical exposures. So we believe that and the market is, more importantly, believing that there is a light at the end of this tunnel, and it isn't a train. It's growth. We will recover. Markets will recover. Economies will recover, and that means that we believe that this lends itself to cyclical exposures. So, commodity countries like Australia, where resources are being exported, recovery, stocks representing a recovery in the economy, and value. We're holding a lot less government bonds today and cash because they don't provide any return and not as much protection as an offset if the markets do have a hiccup as they once represented. We've reduced our exposure to the US markets, as we've seen before, who have taken off much more strongly than other markets and maybe don't reflect the stronger value proposition today. And spread, as we said, to Australia, representing a commodity country, and the emerging markets. We have retained a decent sized exposure to the US dollar because this does provide historically a protection should the markets fall out a bit, if you like. The Australian dollar does tend to decline quite sharply against the US dollar, and that provides us some protection in holding US dollar exposure. So in terms of performance, how have we done for you? How has your money performed? And this is a good news story for the financial year to 2021. All the diversified options are ahead of their stated objectives. The sort of objectives like CPI plus 3% per annum. We're outperforming those objectives quite strongly over 10 years still. We have, as we've spoken about, had a very quick and strong recovery over the past 15 months since the start of the COVID downturn. And the fund's very competitive against industry averages across all time periods. Australian shares over the last 12 months is ranked 5th in the Australian Shares Super Rating Survey. Our bonds option is ranked number 1 over 3 and 5 years in the same survey, the bonds survey, that is the fixed income survey. And even our credit income option can be seen as being ranked number 2 over the 12 months to the end of May. They haven't released the June numbers yet for 1 year out of the Rainmaker survey. Our default option is Lifetime 1. We used to have our balanced option as our default option, and you would have seen a lot of communications. That's 3 years ago now, more than 3 years ago now, that we changed to a new default option, which is called Lifetime 1. It's a life cycle option, which means that it changes your asset allocation to growth growth markets and defensive markets with each birthday. So as you get older, from the age of 40 to the age of 70, it slowly, very gently, just declines your allocation to growth assets and increases your allocation to defensive assets. And this is what we've got in front of us here. Lifetime start, it takes you up to the age of 40. Lifetime grow, you can think of that as the allocation for 50-year-olds, and lifetime build, the allocation for 60-year-olds, and lifetime prime, the allocation for 70-year-olds and above. And these are the returns over 1 and 3 years. Stellar returns over 1 year. You can see that 20.9% for lifetime start for the year, all the way down to 9.4% for lifetime prime. And that just reflects how it's more invested more conservatively for our much older members, 70s and above, because they want to protect that nest egg and grow it more conservatively than, say, our under 40s, who are trying to have smaller balances. They're much younger and have lots of time to ride out the ups and downs of the markets. And so therefore these allocate more to shares, and we'll talk more about that. And you can see the 3-year number, which takes in all of the COVID period, and you still see this phenomenon where lifetime start has a higher return than lifetime grow and build and prime. And these returns, as I've said, taken in all of that COVID period and still very solid returns. This page is a little bit hard to read. It's a little bit squished in. If you just to take you through it, it talks to our other diversified options, shares, which is a blend of Australian and international shares, and growth, which is very heavily allocated to the share markets, both here and abroad. Our socially responsible option, which is for those seeking a very clean and green investment option, devoid of any fossil fuels and so on. Our balanced option, and as we go down from balanced to conservative, capital stable, these are just generally going into lower allocations to growth and higher allocations to defensive assets, less shares and more bonds and cash. And what you can see here is, if we focus on the 10-year numbers and maybe just focus on super, super just means that your investment earnings are taxed at 15%-ish. There's a tax involved. Pension, not so much, no tax. And so that's why the pension numbers are higher. So if you've got an allocated pension in our pension product, you have a higher investment earnings because of the benefit that those earnings are not being taxed. But you can see that these returns generally are declining as we go from top to bottom, other than socially responsible. We could talk to that with questions. And that's indicative of, over the longer term, you expect the more growthy allocated options to perform with stronger investment returns over the longer term. It actually works out that that's been the case for 7 years, 5 years, 3 years, and 1 year. But as we said, this last year, much stronger than longer term returns, as you can see. And we keep saying this, we've said this a couple of years in a row, I think. We don't expect future returns to be as strong.
Thanks, John. Just probably before you go on, I would like to state that these returns are actually as is on our website, so that if you're having trouble seeing these for the moment, if you go to our website and go to the investment tabs, you would be able to see those investment returns listed there as well. The other thing is that just a reminder that if anyone does have any questions, you can use the chat facility or the Q&A facility, and we'll be able to answer those as well. So thanks, John.
Thanks, Paul. We also have some single sector options on our menu. If you just want to maybe make your own allocation to the different types of markets that you can pick from on our menu and make your own balanced fund, if you like, or you just want to be exclusively allocated to one, you can do that. There's no recommendations from me because I can't give you any financial advice. I don't know your specific circumstances, but here they are. Australian shares, international shares, property, bonds, credit income, and cash and term deposits. And again, I'll take it straight to the 1-year returns. You can see those share markets have been very strong. Property has stabilized, even though it did dip a little bit into the negative through COVID. Those income streams have stabilized because we've gone back to the shops, we've gone back to work. Although recently we've gone back to working from home, we did for a while there go back to work in the offices, the shops, and people in the warehouses were back, and those income streams from paying rent, they were coming through. Bonds, as we mentioned earlier, and cash, very low returns here, 0.2% after all of our fees and taxes, and bonds also very low, indicative of what's been happening as a result of those central banks pushing those yields down. Credit income, it has been making its target return, which is about 2.5% over the cash rate. So there's that. That's the market update and the investment returns update. If there's no questions at this time, what I'll do is I'll dive straight into what drives your return outcome. So this is the spotlight on your investment choice. So super is, for the members that are not right across what super is all about, super is just effectively a vessel, if you like. It's an empty vessel. It's a format for which your retirement savings can grow as legislated by the government. But what's inside super, it's not a bank account. It doesn't go up with interest unless you're just invested in the cash option. What is in your super fund in terms of your account balance is decided by you. And if you haven't made a choice, it's in the default option. So what does that mean? It means that you're invested in lots of different financial markets around the world. You may have exposure to the share markets or property markets or to the debt markets, bond markets, or the credit markets. You may even have exposure to infrastructure assets through our diversified strategies, where we have the allocations or investments in infrastructure. And these investments, the valuations in these investments can be volatile, particularly in the share markets. And you'll notice in the news, markets go up and down. And that's why your balance may well go up and down on a daily basis, depending on how you've chosen to invest, or if you haven't chosen, you're in our lifetime one option. So it's really important not to get too concerned about daily volatility when you're invested for the long term. Super, you're basically putting a part of your salary, it's going into the super fund, and then it goes and it ends up in the financial markets according to the investment choice. And your balance will go up and down daily according to how much you've got in shares, particularly. What's important is that over time, your balance will grow. That's been proven over long periods of time that your balance will grow as long as you're willing to bear the volatility of your balance moving up and down. So we've talked about which markets you're invested into. We call this asset allocation, where we allocate to all the different markets by different weight. And we select managers to go out and find the best stocks for you and the best bonds, or to lend the money to the most credit-worthy borrowers, so that we get an interest on that money and we get your money back for you. That's the credit markets. And for the stock markets, for dividends to come through on the profits of the companies, and also to see the value of those companies go up over time. And so we hire world-class asset managers to provide an incremental return, if possible, over and above what the broader markets can offer us or offer you. Now, your investment choice on our investment menu is what largely determines your investment outcomes. I'll say that one more time because it's really, really important. It's your investment choice on our investment menu that largely determines your investment outcomes. So if you've chosen shares and you've had that for the last 20 years, let's see, we're in 2021, since 2000, you've had some wild rides through the tech market, tech bubble, you've had the GFC, you've had COVID, and you're still going. You're still going okay. As long as you held on and you didn't run away from your investment option. If you've held cash, you've just had an incremental interest or yield on your cash that started off maybe at 6%. I know that as a kid going to university, I was earning 18% on my term deposits. That was quite some time ago. You're not going to get that today. That's been coming down over the decades. And the kids of today going to university are probably getting more like 0.5%, but not volatile. So what things do you consider when you invest or make your investment choice? Your time horizon, how long until you stop contributing to your super fund, you know, in terms of, you know, how long are you working for, and therefore part of your salary going into your super fund to buy, to invest in the markets that you've chosen through your super fund, whether that's the stock market or the credit markets. And how long until you start withdrawing from your balance as for an income stream in retirement? That's a time horizon. What's your longevity risk? What's your risk that you're going to outlive your savings? And also, what's your risk appetite? Are you able to hold on to your investments through the, you know, through the ups and downs, the roller coaster, through the rocky times? So these are the most important things to consider in terms of your investment option and choice on the menu. And I'll talk a little bit about Lifetime One in relation to that, because for those who don't make an election on the investment menu, who just leave it as it is, are effectively defaulted into the default My Super option. And as I said earlier, that's been our balanced option today. That's our conservative balanced option, and that's done fine. But we felt that we could improve on that because how is it possible that someone who's just entered the workforce at 20 years old should have the same allocation to the stock market and the bond markets and cash and property for their whole life? So the same allocation as someone who may be still working potentially at the age of 70. How can that be right? And so we designed and moved our default option to Lifetime One. And all it does is just automatically invests members up to the age of 40 into an aggressive, if you like, a high growth investment profile, mostly invested in the share markets here and abroad. And then gradually, year by year, with each birthday, from the age of 40 until the age of 70, just gradually just winding down that allocation to growth investments like the share markets, and allocating a little bit more into the more defensive investment markets, the bonds and the credit markets, and cash. So Lifetime One does this for you based on your age. And this busy slide, what I wanted to serve here is for you to see the asset allocation differences. So mainly this this area called, oh, I can't read that myself on my screen, just bear with me. So the normal percentage, which is what we would allocate to each different market. So we'll start here. This is our Lifetime 140, or we call that start. And this is the strategic or the normal allocation to the Australian share market at 33%, the international share market at 33%, private capital at 6%, and so on. So, but you go down to cash, it's 3%, and bonds, it's 3%. So you can see here, allocated, it has a very growth investment profile. By the time you work your way from the age of 40 all the way to the age of 50, it just declines the allocation to these growth markets, share markets, and starts increasing the allocation to these other more defensive credit income bonds and cash markets. And on it goes through to age, that was 50, and now it's 60. And until we get to the age of 70, where there's only 11% in Australian shares and international shares, and much higher allocations to those defensive asset classes. So that gives you an idea. And we just smooth the ride for you from age 40 to age 50 and declining those allocations year by year. And how does that compare to our conservative balanced option? Well, here it is at 19.5% in each of Australian shares and international shares. So you could probably see quite clearly that our conservative balanced option is actually the lifetime one 60, or we call that lifetime build. It's basically the same. So that's just by way of explaining what goes into your investment. What is your balance made up of? It's what you choose. And if you don't choose, this is how we invest your money for you.
Thanks, John. I have got a few questions there, and we'll come to those in a moment. So if anyone would like to make some more questions there, please use the Q&A or the chat facility, and we'll come to those in a moment. I suppose when we're in these sessions, we've always got to ask ourselves, well, how can the fund help you even further? There are two ways of getting some just general information. I'm the Brisbane Regional Manager. I can be contacted by those Brisbane members, and we have regional managers in all over in our offices within Port Macquarie, Townsville, Sydney, Canberra and Perth. So you're more than welcome to speak to those and have a personalised appointment, and they can give you some general information. They can assist with, completion of forms, taking you through the online facility if you wish, because you can actually make an investment option or change to your investment option. So if you do want to get in contact with those, call the 1300 number, and I'm pretty sure the call centre will be able to put you through. Otherwise, the call centre, maybe if it's just a simplistic question, the call centre will be able to answer your question there as well. So the one thing that we're going to do tonight is that in a moment, Justin is going to push out a link that if you do want further information from our fund, then you can click on that link. I notice he's just done that now. You can click on that link and you can request for someone to give you a call back. So we can certainly do that for you if you wish. If you do wish to actually get some advice that's tailored to your needs, so we're moving away from just the general information to the limited advice section. The limited advice section certainly can provide you with over-the-phone advice that's personalised and at no further cost. The only cost is really your time that takes to conduct this appointment. We just say to allow about an hour. What they can do is that they can ask you some questions and provide you with a recommendation that suits your investment style. Like John, they also don't have a crystal ball in terms of their performance or the recommendation of where they're going to go to. So they do that to an investment option that's tailored to your style. So if you do wish to speak with a limited advisor, they can provide you with assistance in terms of investment options, but they can also talk about salary sacrifice insurance and transition to retirement. So certainly they are available. Last, but certainly no means least, is our comprehensive advisors. So really, I always tell members is that the limited advisors that I just previously mentioned, they just provide you with single topic advice. But if you want a holistic approach to your savings, your retirement goals and the like, they can assist with a large number of items and bring that back to you in what we call a statement of advice. I really call it's a blueprint. It's black and white. It's written down. It'll provide you with quite clear, quite simplistic to understand details of where your finances are heading. And I always say to people is that the great detail in this, it talks about what John mentioned in terms of longevity. Making sure your fund will last for you throughout your retirement. So these financial advisors can sit with you on a one-on-one basis. We're doing a lot of these appointments via Zoom these days, so they can still be face-to-face, but obviously with the current climate, we're doing these via Zoom, and we can do these appointments over through that facility for you. The team are nationally represented, and you can certainly find a financial planner that will be able to assist your needs. So again, if you do want to go down that path, the comprehensive advisors are available. I suppose the other thing is that you can also consider is that there are a lot of answers that you can, or places that you can seek information. So certainly I would also recommend, we do obviously have through our social media channels, but also on our website with some latest information. I would say that I've got a couple of questions there, John. Just the first question that I'll tie off, Regional Manager for Sydney. We have our Justin Colley, he's a Business Development Manager. He is assisted by Wayne Grant and also Georgetta Sarby within the Sydney office. So if you ring that 1300 number, they will be able to give you a call, or even if you just click on that link, then the appropriate person will give you a call soon there. Anne, if you've got that, want to ask that question. I suppose the other question that we've got there, John, is for you. That is terms of Kathy has asked that, talking about these emerging markets that we mentioned, if these, if we're investing in these industries within these countries and they're actually worse hit by COVID, won't they actually be slower to rebound in terms of returns?
Yeah, that's a great question, Kathy. And that's exactly what's already happened. And that's why they represent particularly good value today. Don't forget that the stock markets, the financial markets do look forward. And so the returns that we've seen in the developed markets have already looked through the recovery that's accrued to well-to-do countries, including Australia, developed countries, because we get first, it seems that we're getting access to vaccines. The population can go about their business much sooner, as we've seen with Freedom Day in the UK, and their economies opening up, and those markets have already roared ahead. So today it's more about having these, looking forward to these emerging countries with their recoveries. And yes, it will be a harder road, but the markets look forward. And so you need to be invested and ready to access the rebound in those markets when it comes through.
Okay, John, we've got a comment here from Tom. This year's numbers are fantastic, and there was a thank you provided. Can they continue at these levels going forward?
Well, we've said no for a while now. So these are the sort of returns we've seen. If you look at the pension returns, so that we don't look at the tax impacts, just fees and costs, these are very, very strong returns. Would you expect to see them again? I would expect not, but I don't have a crystal ball. I don't know what's going to happen day by day or month by month. If you look back to 3 years and 5 years, 7 years and 10 years, you get a better sense for what longer term returns look like. And these 1 year returns do look quite outsized against the longer term returns. So the answer has to be no on the balance of probabilities. Do I know for sure? I do not.
No worries. I was going to say that if you do have the crystal ball turned on, can you have tonight's Thursday night's lotto numbers sent through?
Sure.
I suppose the other thing is that asset prices, we've got another one here from Bill. With asset prices at such high levels, what are you doing to protect our retirement savings?
Yeah, it's a great question. So where we've had some exposure to those stronger markets and have accrued profits for you, where you have invested in share markets, we've just taken that back a little bit now, back to a more neutral stance, and taken those profits and put them into more liquid defensive investments, and but also reconfigured our, as I said earlier, our exposures so that we have less in the US market where it's really quite expensive, and a little bit more exposure to, I guess, the commodity country value and pro-cyclical stocks of countries like Australia and some of the emerging markets. So it's about just taking some of those profits off and just de-risking a little bit.
Lovely, thank you. During the presentation tonight, you talked about office premises and retail environments and the like, and I'm pretty sure that we have exposure to those in our portfolios. I suppose this question's come in regards to airports. You know, they're quite obviously a common investment vehicle for trusts. If no one's travelling, how is those prices holding, and do we continue to seek, I suppose, investments within these commercial, office, retail, warehouse and airports and the like?
Yeah, fantastic questions. So if I just draw your attention to the property returns here, where you see the 1 year return. Let's go to pension, 6%. Looks very strong, right, for the 12 months or the year to the end of June. But over the 3 years, a lower return, 3.4%. And that really, that gap between that 3.4 and 6, it tells a story. It says that more than a year ago, just when COVID hit, and we all were working from home if we could, and we couldn't get to the shops at some point, we were locked down, and we had issues with our shopping centres because you know, there was rental relief required. So the tenants in the shopping centres, the retailers, they weren't making any turnover or as much. They couldn't afford to pay the normal rents, and so agreements had to be struck in terms of lower rent for that year, and this impacted valuation. So you get the valuers that come out, they value the shopping centres, the offices and the industrial assets, properties, and the valuations reflect the fact that the income's just not coming through, more so for shopping centres than for offices. And the least impacted, of course, were the warehouses, particularly the ones that were distributing goods to our properties, right, as we were buying more things online. And so that's what happened through COVID. But with the return, we saw, before this Delta strain came through, we actually saw retail consumption at shopping centres exceed their pre-COVID levels, which is astonishing to think. So it wasn't just a recovery. They exceeded the pre-COVID levels. Rents were coming through, income was coming through. But what happened to valuations through COVID? They actually dropped quite severely in shopping centres, around about 20%, but the income has stabilised and those valuations have just come back a little bit more now. And yes, Delta is taking its toll again, but looking forward, just like the stock market does, looking forward, we will go back to the shops at some point. People love shopping and physically going to the shops. Yes, there'll be more take up of online retailing, but we will go back to the shops. We saw that before Delta hit. We went back to the shops. The rents are going to be paid, and those valuations are likely to mean revert. So that goes to airports as well. At some point, the economies will open up. At some point, we will be traveling again. Maybe behaviors will change on the margin. Maybe they'll change a little bit more materially. Maybe, you know, maybe we won't get to travel as much for business as we used to, but people will travel for entertainment, for tourism and so on. So we expect the valuations of airports will mean revert as well as we come back to using those key infrastructure assets.
Lovely, thanks, John. I just want to thank you on behalf of the membership of the fund. I want to thank you for your presentation tonight. I also want to thank you for the difficult work that you have to do in making sure that our retirement savings are protected, but also getting a good return. So thank you very much, John. I greatly appreciate it. And certainly thank you for your input here tonight. I suppose for those viewers that are attending tonight, Yes, you do have a link that if you want further information, we can get the appropriate regional manager to give you a call. If you do wanting to seek some financial advice, we can certainly get someone to give you a call and to arrange an appointment time with the appropriate planner. I thank you for your presence here tonight in viewing this. We wish you all the best, whether you're in lockdown or not. I know one thing in Brisbane, this is our first full day out of lockdown. I'm not too sure how long we're going to be out of lockdown for, but we're out, we're free, although the city is significantly quieter today. But certainly we wish you all well with your families. Keep safe, and I always say keep happy, warm and well. So thank you very much for attending tonight. If you've got any questions, give us a call. You've got the phone number there for the fund. So thank you very much and good night.
Good night all.